Welcome to the OANDA Market Pulse Charting Analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, as I've already highlighted in the previous videos for those who watched, we've started a new format going forward. On Mondays, I'm going to be putting out 3 videos, an FX charting analysis video, a commodities charting analysis video, and a indices charting analysis video. The reason for this is because I want to give a more in-depth view of the markets, covering more currency pairs, commodities and indices. I'll then use the videos as we go on later in the week, the daily technical analysis videos, to provide updates on any charts where we've seen some significant moves, but this just gives us an opportunity to provide more in-depth and give people easier access to the charting, to the charts that they are looking for. So this one is the commodities video. Got 5 different commodities lined up for you. We'll start here with gold. Now, of course, gold is one of the more commonly traded commodities. Safe haven appeal of gold has given it some support as of late. You can see, of course, the first week of the month that it did get a lot of support because of the risk aversion. The risk aversion association that comes with gold. Now, last week we did see it pull back and almost test the lows of the week before, which was quite interesting, although we did see it rally into the end of the week. So while this isn't necessarily a hugely bearish candle, I wouldn't say it's overly bullish either. I think this week's going to be very interesting for gold. The fact that we tested or came close to testing the previous week's lows suggests to me that we're in a bit of an uncertain market at the moment. The fact that we rallied into the end of the week could be a bullish sign. So you've got bullish and bearish signals here on this weekly chart at the moment. I'd say the bias slightly leans towards the bullish side, just simply because we have taken out those prior highs. The fact that we failed to make new lows, the fact that we failed to break the lows on the prior week, and the fact that we rallied into the end of the week, even though we ended lower on the week, I'd say this has a slight bullish bias here. Now, this so far today we've seen very little, but before I cover that, a couple of things I wanted to highlight here is the fact that if we do see a break above the highs from a couple of weeks ago, which is 11.1370. The next notable level for me really is going to be around these 1140 levels. Now, I know during this period the 1140 level didn't really come too much, wasn't a big factor really. We didn't see much market reaction to these levels. The fact that it was such a key level of support in November 2014 and again in March 2015 suggests to me it could come into play once again. Not guaranteed, but it's certainly a level I will personally be keeping an eye on, especially if it coincides with the 55-week simple moving average. Beyond here, I think 1190 could potentially be very key if we do again reach these levels. We've got this descending trend line from May 2013. We've got the 100-week simple moving average, which has been key on a number of occasions in the past, most recently the January of last year. Prior to that, you can see that it provided support during the upwards move here, and prior to this again on a couple of occasions it did provide support during the ascent in gold. So for me, this could still this could provide additional resistance if we do reach these levels. And of course, we've still got these prior highs again from October. The fact that these 3 coincide around the same level would suggest to me if we do reach these 1190 levels, then that could be a very key area of resistance for gold. Moving on to the daily chart, like I say, we haven't seen too much action today. Of course, it is a US bank holiday, so trading volumes are naturally lower. That can sometimes lead to increased volatility, but today this hasn't been the case in gold. We haven't seen the same kind of risk aversion overall, I'd say, in gold. Of course, there has been parts of the market, of equity markets trading low, which sometimes points to some form of risk aversion. But then you look at the currency markets, and broadly it's the risk currencies which are actually in the green today. So I don't think we're seeing the same kind of risk aversion that gold normally benefits from, and maybe that's why there's a bit of a lid on it so far today. But a couple of things, another thing which wanted to highlight really here is, aside from the I did highlight, of course, that I said the bias really probably is to the bullish side. We've also got the fact that having come off the lows, having come off the highs, we did pull back to the 61.8% Fibonacci retracement level, and we have rebounded off there. Now, we haven't seen an overly aggressive move higher, but this just adds to that little bit of a bullish feeling, really, I guess, in gold right now. And while I don't think the outlook is necessarily clear or obvious for gold, I would say that things are looking a little bit more bullish, and the next real test for it is going to come from these 1113 levels. If we can see these broken, then that would suggest to me that things are looking far more bullish once again. Next, let's move on to oil. Of course, a very heavily traded commodity right now, very popular commodity due to the sell-off and the strength of this sell-off. The nature of it is quite unusual to see such bearishness in the market. Usually a sign of an overcrowded trade, but right now this doesn't seem to be the case. Everyone seems to be extremely bearish. We've fallen below $30 a barrel, which is very unusual. Which will also say very unusual. It's been more than a decade since we've now traded at these levels. Starting with the weekly chart here, again we've had the last couple of candles were very bearish. You obviously saw the evening star formation here. We've had two rather bearish candles since opening near their highs, closing near their lows. Of course not perfect, so they're not Mariposa candles, but you can still see that this is a very clear bearish signal here. Momentum doesn't seem to be being lost at this stage, whether it be the MACD histogram, the moving averages, or the stochastic at this stage. So things continue to look bearish for gold, for WTI. I think the next real supports have to come in around these 25.50 to 26.50 levels. Now, like I mentioned a minute ago, we are looking back years since we've traded at these levels. These are the lows from back in April 2003 and September 2003. I think this is the next major level of support for oil at this stage. It may take a little bit longer to get there because the sell-off until now has been so aggressive, but really there doesn't seem to be much bullish sentiment in the market right now. Doesn't seem to be much reason, especially from a fundamental perspective. Today we've seen oil decline once again. This has come on the back of Iranian sanctions being lifted. We're expecting around 100,000 barrels of oil to return to the market from Iran within the next month. Over the next 6 months, that could rise to around 500,000. Within a year, that could be 1 million barrels of oil returning to the markets every day. So of course this is going to add to the supply side issues that we've got in the market, add to that the demand side issues, the fact that we've got slowing growth in China and Chinese growth concerns, emerging market growth concerns. These are also adding into it, and of course the stronger dollar, which is providing further issues. Everything seems to be pointing to the downside right now for WTI and Brent, and really I think I'd be quite surprised if we didn't see at least these 25.50 to 26.50 levels hit in the next couple of weeks. We're seeing a lot of days where WTI is trading in the red, and we're not really seeing any reason to assume that we're going to see anything other. Like say, momentum continues to be to the downside, and these candles are still very bearish. So I remain quite bearish in WTI. Brent is very much the same story. We can see this weekly chart here, extremely bearish. We've got this trend line which isn't even been tested for quite a while now because the sell-off has been so aggressive. If we look at the daily chart, again, we're continuing to see this pressure to the downside. 28.25 is a previous support. I'll actually show you this on the weekly chart. Like I say, we have to go back some time. We have to go back more than 10 years to look for historical support levels. And really, with this current support level, this is just these prior lows at these levels here that we saw back in February 2004. But I think this is only going to be temporary support, as with the next one. The next one, 27, 26, this prior support here. I do think it's probably just going to be temporary. I think the ultimate aim is going to be these 25 levels next, and beyond them we could even see it fall back towards 20. But in the short term, just temporary support, I think, at these levels. We have seen a bit of a rebound off here, but that could just be top profit taking, and there's no reason really to believe at this stage that this is anything more. Potentially some signs of divergence growing, bullish divergence here on the stochastic and MACD, but these are very mild at this stage. No reason, in my opinion, to be bullish on this in particular, to be bullish on this in any way. I think really what we're just seeing is maybe a little bit of profit taking, maybe a bit of consolidation even, rather than any form of rebound here. You can see that all we've seen today is a move back towards these prior lows from the 13th and 14th of January, and then of course we've seen a rebound back off those levels as well. So we've seen, once again, we're seeing selling into rallies again. Very bearish signal for oil. Let's move on to silver next. And again, you tend to see a similar story in silver as you do in gold. Maybe it doesn't benefit quite the same from the safe haven appeal, but we can see that we're seeing fairly similar patterns here. We're seeing a long-term downtrend, that descending trend line capping any rallies that we really see in silver. That descending trend line coming from August of 2013. If we zoom in just a little onto the daily chart here, we can see that we've seen consolidation around this phase, predominantly trading really between around these 13.75 to around 14.40 levels. So we are seeing a bit of range bound trading right now, kind of maybe a bit even, I'd even go as far to say it's quite choppy markets. One thing I would say is the highs and lows do seem to be converging at this stage, so maybe this is a bit of just consolidation at this stage, and given the fact that we've seen a sell-off before, that would suggest to me that the market still remains quite bearish. But again, as we've mentioned previously, while these are converging, and I think 13.75 to 14.40 seems to be the current trading range, we could continue to see evidence of these converging. Beyond here, we could see it break out towards these 14.50 and even 13.50 levels. But until we see really a breakout of these, of this pennant or triangle, or just ascending and descending trend lines, then I think we are going to continue. I think we could. I've got no reason to believe that we're going to see a change in this. I think we have seen a significant sell-off in this. We've seen it reach these multi-year lows, and it's going to take something quite significant to push it to the downside. But once we do, I think then these 13.50s become key, and beyond here, we're looking back towards 12.45, say 12.50. And again, we are looking back years to find the last time we've traded at these levels. So what is it, 12.50 and 11.50. We are looking back at July 2009. Of course, this point here is the height of the financial crisis, just to give some perspective in this. But like I say, this is range bound at this stage. This is converging highs and lows. There's no reason at this stage to think there's going to be any different. This looks to me like just a consolidation, and there's no reason to believe that it's going to change anytime soon. I think we could even have another week or two of this to come. Finally, copper, and again we are trading at multi-year lows. I feel like I'm having to repeating myself all the time. It just seems to be the case in so many different commodities and currencies right now. Multi-year highs or lows. We've broken below the $2 level, and we have seen it pull back. I do think we could see 190 in the short to medium term. We are seeing some consolidation today, but as you can see again, this doesn't appear to be anything more than consolidation. The last two candles do appear quite bearish. If we do see it continue to rally, I think $2 could cap any rallies we see. I'm not really seeing too much reason to be overly bullish on this at this stage. This is suffering from a similar conditions that we're seeing with oil. Oversupply, falling demand, given that China was such a driver of demand, the slowing economy there, the slowing infrastructure investment. These are all going to have an impact on copper, and therefore prices, their fundamentals really do dictate continued decline in prices, at least for now. We are seeing some consolidation in this, but again, if we drop down to the 4-hour chart, this looks to me more like consolidation, which is bearish consolidation more so than anything else. I'm not really seeing any reason to believe at this stage that it's going to be any different. We did see a rally back, as if we were going to see move towards these $2 levels at the end of last week on Thursday. We ran into prior support, and then we saw the pullback. Now we're seeing lower highs being made from today from Thursday. So for me, this remains quite bearish. I'm not seeing any reason at this stage to be anything else, and I think these 190 levels could be in sight fairly quickly. If we see these broken, then we are looking back again. We'll have to bring up the weekly chart to see what we'd be looking for below these 190 levels. We are looking at the 190 levels here. We could potentially be looking back towards at least in the medium term around these 175. Whether we can reach the lows from the height of the financial crisis, is yet to be seen. I think this could be stretching things quite a little bit. I think if we could see 175 in the medium term, that could be a key test for this. But I think right now 190 remains the next key level of support, at which point maybe we'll see a correction. This has been a long bear market for copper, and you would start to think that at some stage we're going to have to see some prolonged consolidation or a correction. Maybe that will come around these 190 levels. Maybe it'll wait till 175, but I think 190 is the next key. $2 to the upside, I think, could cap any gains, and we could see potentially people selling into any rallies that reach these $2 levels. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA FX Labs, which has a lot of great tools designed to help you with your trading.